Broadcom Q3 earnings just came out, and Wall Street is definitely not liking it, as in the after hours, we're seeing at the current moment, shares of Broadcom down by about 5%. We'll talk about some of the reasons why shares of Broadcom are down in the after hours. A lot of it has to do with the forward guidance of the fourth quarter. We'll talk about how this company grew over the past year, as revenue came in at a whopping $13 billion and some change. That's 47% growth year over year. But the devil's in the details. How much did the core business over at Broadcom, as most of you know, the company purchased VMware over the past 12 months, and that is leading to a lot of the revenue growth that you've seen year over year. Speaking of the revenue growth, we'll look at the revenue, the profits. How has Hock Tan integrated VMware? Are the sales and the cost starting to balloon over this company, or is he keeping a lid on expenses and continuing to drive bottom line results? We'll also take a look at cash flows, very important as it relates to Broadcom, and we'll come over here and look at this technically. I think you'll probably all agree this is definitely a stock that you want to own for the long term, since back in 2010, the stock has pretty much only gone up minus a few deviations. So after the Q3 results, do you step in and buy the dip on Broadcom? We'll answer that a question and more on today's show. What is going on, investors? Hopefully, guys are doing well out there. We got Broadcom today. Over the last year, this thing's up big time, up 75%, even year to date, up 36%. Any way you slice it, this thing has been doing pretty darn good, but we are seeing a slide this week. A lot of volatility in the markets, and semiconductor stocks in particular going on a slide. Now, Broadcom is a unique semiconductor company because they also have a software business, which they've acquired mainly through acquisitions. Now, revenue came in at $13.07 billion in the quarter. That was 47% growth year over year. The Wall Street expectations were right around $13 billion. The high-end estimate was closer to about 13.8. So the company just constantly meeting those expectations. If you know anything about the CEO, Hock Tan, he likes to set the expectations relatively low and then have a natural beat. He has kind of a private equity background, so he knows what Wall Street likes. He knows what analysts like. He doesn't want to create any surprises. Now, we did get a surprise, though, maybe a disappointing surprise. The fact that the fourth quarter revenue guidance coming in at $14 billion. But keep in mind, this company is relatively conservative, but that was what Wall Street was expecting. In fact, the midpoint estimate was for a little bit over $14 billion. The high end was for $14.6 billion. The company just beat expectations by about $110 million. So you gotta expect Broadcom going to probably come in at 14.1, maybe as high as 14.2 next quarter, but that certainly is not meeting the expectations that Wall Street already had set, which was for 51% growth year over year. Now, the growth is a little misleading and a little deceiving for Broadcom, as they completed a gigantic acquisition of VMware over the past year. In fact, if you look at the company's financials and look at the details, that the company grew 47% year over year to $13.1 billion worth of revenue, but minus out the contributions of VMware, which was acquired over the past 12 months, and you compare the core business that existed 12 months ago for Broadcom year over year, you actually grew, and I say only 4% year over year. Now, company is certainly one of the largest AI accelerating data center providers of those chips, including networking and custom accelerators, particularly for Google. We'll talk about also that Broadcom is potentially going to work with OpenAI about producing a new AI chip. If you are a premier software provider and you want to create your own custom silicon, Broadcom is certainly a phone call that you'll have to make. Now, over the past year, this definitely looks a little bit light compared to NVIDIA, but we have to keep in mind, NVIDIA is the Michael Jordan of the AI accelerator data center business. Broadcom, very much a major player there, as they expect revenue in this fiscal year, which ends next quarter, to be about $12 billion. Now, obviously, NVIDIA is doing that every month and a half. Just gives you an idea of where NVIDIA is with their business model, but certainly Broadcom playing a very close second, as AMD's business model, I don't even think has eclipsed the double-digit mark, but also keep in mind that Broadcom's numbers do include some networking equipment as well. So we had that $13.1 billion worth of revenue. Keep in mind also that we got guidance for the upcoming quarter. We're going to come in at about $14 billion. The way the company laid out their financials is last year minus VMware, we did about $8.9 billion. Now you're bolting on a gigantic software business, so that increased your revenue. So really the way you are going to look at this, at least in the shorter term, till that VMware acquisition actually starts lapping, and you can probably see that on the company's estimates as you get into Q2 next year. Company's expected to grow kind of low teens, mid-teens growth rate, at least on that revenue side. But the revenue is not the full story. When you have acquisitions like that, you have to have the right management in place to find those efficiencies. You don't need 2 accountant staffs. You don't need 3 or 4 different corporate lawyers. You just need the ones that you had in your core team. And you're going to see evidence of that when we roll through these costs. You do have some amortization of acquisition related assets. Those are going to roll off at some point. We're seeing those flatten out quarter over quarter. Total cost of revenue, despite the growth quarter over quarter from 12.5 up to 13 billion, notice that your total cost of revenue basically flat. That's exactly what you want to see. So higher revenue, lower costs that led to higher gross margins from 7.8 up to about $8.4 billion. Now, we did spend a lot more on research and development. $2.4 billion, basically flat quarter over quarter, but obviously $1 billion higher than it was last year. Now, you got a much larger company, so your selling general administrative expenses also going to completely balloon. This is what Hock Tan is known for. Notice last year on $8.9 billion of quarterly revenue, they had just $388 million worth of SG&A costs. It probably pains this guy. He's probably losing sleep, the fact that it ballooned to $1.3 billion, $1 billion over what it was a year ago, or at least almost. Notice that that has trimmed from 1.3 billion down to 1.1, and I would imagine as we get into next year, the company is going to figure out a way to get this cost under $1 billion. So you're going to have more cost savings likely as we continue to move forward. You have some restructuring and other charges, as obviously people are losing their jobs when you have combined companies like this. Some of the staff that is not needed, that was already existed at Broadcom, lose their job. We feel bad for them, but they are getting severance and other type of pay packages. Those are recognized here. We'd expect those to roll off the books as you move into next calendar year. Your total operating income came in at $3.8 billion. Disappointing considering last year you did $3.8 billion. But again, it's not the full story. Quarter over quarter, you went from, we'll call that $3 billion up to $3.8 billion. So everything looking pretty solid from a balance sheet perspective. Cash is rolled off the balance sheet as you'd expect as they completed a gigantic acquisition. Long-term debt ticked up big time from 37 all the way up to 66. Lower interest rates will definitely benefit Broadcom, as they're probably not paying a huge percentage on that note, but what it will do when we get to cash flows, we'll show you. They outlaid a lot of cash to repay long-term debt. Well, one strategy they can do is when interest rates begin to drop again, likely in the next month or two, well, instead of having to pay off all the debt or some of it, you might be able to roll it over into a new term debt, and that will certainly benefit the company, at least from a cash perspective. From a cash flow perspective, everything's actually pretty steady. When you strip out the restructuring, strip out all the costs that the company has had to incur over the past year or so, you notice last year you were at 4.7, now you're closer to 5, last quarter you're 4.6, so you're certainly moving in the right direction. Give this company another 6 to 12 months and things will look really, really solid from a cash flow perspective. They sold the business in the most recent quarter, but you see the strength of this business once you kind of lap some of these acquisition charges and those types of things. Well, you're creating, we'll call it right around $5 billion of quarterly operating cash flow. But look, they don't have to do anything. They're not building, fabricating facilities like Intel is doing. They spent just $172 million. In fact, if you're in the Bay Area and you drive by the luscious offices of Google or Apple or Meta, and then you drive by Broadcom, you almost miss it, okay? This company is known for having things really lean and mean, and when you drive by this company's office building, it certainly doesn't look like a company that's worth north of $700 billion. You got to respect that as a shareholder. Now, if I wanted to work somewhere in the Silicon Valley, probably wouldn't be Broadcom. I'd like all the perks that Google and these other companies offer, but when you're a shareholder, these types of companies can really, really pay off. Now, we talked about how they issued some debt in the most recent quarter to about $5 billion, but they paid off about over $9.2 billion. That's what we're talking about. When they lower interest rates, it could be that you don't necessarily have to pay off it at this aggressive of a schedule. Maybe you lighten that back, look for some other acquisitions, as this company has just proven itself over its entire history to do a very good job integrating companies from an acquisition perspective. So could be future growth opportunities going forward. You get a dividend with this one. They had some share repurchases, but that certainly slowed down at least the common stock in the most recent quarter. Things are looking pretty good from a financial perspective with Broadcom. Now, we are seeing a dip in the after hours. We'll put up a good old fake red candle like we always do in the after hours. We have broken what I would say was kind of the micro trend or the shorter term trend that you've really been in. Well, maybe it's slightly more than a short-term trend, more of an intermediate trend since October of 2022. You've been really steep with this one. Those have to give up at some point, and I think we're giving those up. You look at the chart of NVIDIA, other charts in the semiconductor industry are starting to look very similar, but you've got some big consolidation areas here with Broadcom. In the 120s to 130 range, this is where some buyers should ultimately step in on the stock. Now, it'll still be relatively overextended when you zoom this out and look at kind of the full view since 2009 or so. This thing has just been in a beautiful channel. So it's been very, very predictable. So as we talk about this level at 122, 130, certainly not all the way back down at the bottom of the channel. When you get those moments, you really got to move. But you've seen over the past decade or so, you've only had, and this is a weekly chart that I'm on with Broadcom, you've only had a couple of weeks to move on that stock. So we're looking for this one more in the middle of the channel. Give it some time, and I think you're going to be able to get this one back in the 120s, 130s. That's where you start a position. You're already in Broadcom. That's where you maybe throw a couple of more shares, because financially, this company is looking absolutely great. I think you give them another 6 to 12 months. They'll clean up some of this acquisition stuff. You've got the tailwind of the chip industry, sick and tired of paying 78% gross margins to Jensen Huang and NVIDIA. A lot of them are going to be producing their own AI chips. The networking side of Broadcom goes without mention, and obviously the software business, including VMware, will continue to produce steady results going forward. This one's still priced to perfection, but any more pullbacks, probably another $10, $15 from here, and it'll be your time to move on Broadcom. Hopefully you guys enjoyed today's video. We'll be back again tomorrow with the FANG Stock Recap Show. See you then. Good luck with your investments.